Hey folks, David Frost, my strategic forecast. You're here for another episode of Common Sense Market Analysis. Today is Friday, January 20, 2017. We're looking at a daily chart of the SPY or SPDR, which is the proxy for the S&P 500. Well, they did it again today. They tested the 226 level and they closed right back above the 226.59. So you can see day in and day out how important these levels are, and the market is very compressed up in this area, and that's why there's several price levels up here that have extreme importance. So again, above 226.59 is bullish for the market. Below 226 is going to be bearish. That's our pivot. Our pivot is going to have a range. So our pivot on the downside is 226. Our pivot on the upside is 226.59. Now, even though we closed above 226.59 today, I'm going to make what I'll consider a relatively bold call. It's not so bold. I've been talking about this for a while, but I'm going to state that next week is going to be the week, without a shadow of a doubt, for the breakout or the breakdown. It's inevitable. The market is compressed. It's coiled up. It's in a bullish formation, which leads generally to higher prices. However, we'll see which direction it goes. We know the game. We know where the downside targets are. We know what happens if we get below 224.66. That is going to be support, by the way. So if we do go down, expect 224.66, or call it 224.50 for argument's sake, to be support in the market. If we close below that level on a daily basis, that brings in 219.56 into play. Now, yesterday I made mention that when the election occurred, the presidential election, when that occurred, the market rallied after that. And we rallied pretty much right up into the inauguration, while even though we went sideways for the last couple of weeks, we never really sold off with anything of substance, and therefore the rally was basically sustained. But what I will tell you is I am expecting another move beginning on either Monday or Tuesday, and whether it's in the up or the downside, I don't really care. I just want to be correct. I'm prepared for both directions, as should you. We've been through these scenarios before where the market goes sideways for an extended period of time. But 100% of the time, the volatility picks up and it comes out of that sideways position. Now, if the market goes up, the volatility as it's defined by the VIX will obviously come down. But when I use the term volatility, sometimes I'm just saying the extreme of the markets, meaning on the up or the downside. Not necessarily, in this case, was I referring to the VIX. We know with a market on the rise, the VIX goes down. And so we're coiled and we're going to move, and it's going to move next week. Now, here's the call. If we don't move next week, I'm saying we will. If I'm wrong, then I'm going to give everybody here a free course that I'm working on, which will be done shortly, on everything that I talk about each and every day in the markets, but it's all condensed, or as much as I could condense it into a video-based course. So if I'm wrong and the market doesn't break out of this sideways consolidation pattern next week, then everybody's going to get that course for nothing. That's my commitment to you. That's how confident I am we're going to make the move next week. Before we move on to the next market, I just want to make mention of a couple of interesting points that are found on the intraday chart. So item number one, 10-minute chart. You can see what happened at the end of the day. The last 10-minute candle of the day rallied up to close above 226.59. Now, these are computers trading the market, and that's not in total, but that's the way that happens. It's a buy program that comes into the market to drive it to a certain price or above a certain price. Now, does the people, or do the people that program the computers, or do the computers know 226.59? No, that's my number that I've calculated from a mathematical standpoint. However, There obviously is some consistency, not all the time, not 100% of the time, but a lot of the time with the numbers that we talk about and the market closing above, on, or below certain numbers. So there is some consistency with these numbers and what the markets do at the end of the day from time to time, especially when we're condensed and trading in a very narrow range. You'll find the market going to certain places towards the end of the day. We've seen that over and over and over again, day in and day out. You can see it down here at the 226 level. You can see it up here at the 226.59 from another day. It just goes on and on. But there's one more thing that I want to point out on the hourly chart that I think is worth noting. So we had a gap higher this morning, and then we basically pulled back the majority of the day. And then the last hour of the day was a bullish candle and an up move. Now, what's interesting is if you look at that from a pattern perspective, what I see is an up move, a pullback pattern, and another up move starting, which generally, if it's an ABC pattern or a zigzag pattern, as they're called sometimes, will bring us in completion at least over the high of the original gap higher from today. So I just thought that was interesting. That seems to be the pattern that's developing. But again, with the weekend coming, we'll see how Monday opens up and how that will dictate the market for the remainder of the day and then on to the week. Now I'll flip back to the daily chart and then we'll take a look at the IWM real quick. And the IWM was up today a little bit more than the spiders, not too much more than the spiders, but more nonetheless. And again, we're compressed just like the spiders. This is a bullish pattern that now is almost trapped in between the 20 and the 50 period moving average. So we're going to see a breakout or a breakdown in this index, the IWM, one way or the other, and I believe it's coming next week, and I will hold to my promise. I just have to finish the course first, but it's close. So all in all, there's really no change from yesterday to today in the IWM. So we're going to have to wait till next week to see whether it does break out or break down. As it stands now, in no uncertain terms, this is a bullish pattern, okay? But keep in mind that patterns like this, a bullish pattern has a tendency to fail at highs, and a bearish pattern has a tendency to fail at lows. Not 100% of the time, not even 50% of the time. I don't have a percentage. I'm just saying the failures happen to occur at highs and lows more often than they don't. It will be interesting to see where the month of January closes, since we're now only 10 days away from the end of January. It's going to be interesting to see where we close as it relates to the trend line that comes from the monthly chart in the IWM, and whether we can close above or we continue to close below that line. That is going to be a very, very important number for the IWM. And you can see here when we go down to the daily again, I mean, we've been trading right around that line for quite some time, for almost 2 months now. So when you think about it, does that line have importance? Is this price area important for the IWM? You betcha. It's not me telling us, or you, that the price level is important. This is the chart telling us the price level is important. Once you can read the chart and understand what we're looking at, and I know all of you can, once you can understand what we're looking at, it's like learning another language. And you get to open up your mind to see things that other people just can't see. And that's what gives us the advantage in the markets, at least an advantage over the average Joe. Now tonight, I want to bring up the chart of the VIX, because the short-term VIX, it was very interesting what happened today. When you look at it, the short-term VIX was down over 10%. And the market really wasn't up or down that much. It was SPX, the cash S&P index, pardon my fumbling, was up 7.5 points. The Dow was up 94 points, and the NASDAQ was up 15. So this is not a day where the VIX, or you would expect the VIX to be down 10.5%. So the question is that tipping the hand that the market's going higher into next week? It's possible. Or is it a fake out or some other explanation that I'm just not aware of? And that's obviously possible. But I thought it was interesting enough to bring to your attention and to have the discussion about it, about is the VIX a canary in the coal mine telling us that into next week we're actually going to see the breakout instead of a breakdown. Very possible, interesting in the VIX. This is a very interesting move today in the VIX, at least in my opinion anyway. And when you look at an hourly chart, I mean, you could see what happened here. Here's a gap lower, and that was on the gap higher in the market today, so that makes total sense. And then you had a down move, you had an inside wedge pattern, a bearish wedge pattern, and then another move down. But then you had the secondary move down all the way down to 1150. I thought it was interesting, and it's something we want to be aware of and watch into early next week, because I think that this is potentially a canary that played out today of higher prices to come in the stock market. But there's nothing you can do with this information. Obviously, it's after hours. That's not the point. The point is that you wouldn't necessarily take a trade long the stock market leading into a weekend because the VIX was down on Friday. That's not a reason enough for a trade, but I think it is interesting information, and you know how I use this information. It's another piece to the puzzle that goes on the table that we want to be aware of. It's a part of a puzzle. It's another tool in the toolbox. We want as much evidence as we can collect to give us the roadmap of where to go. All right, let's go over to the transports, and we'll go back to the daily chart, and we'll take a look to see what happened. Whoops. Okay, so the transports had a decent update today, up 60 points, 0.6%, and we tested the 91.42 on the downside, made a run for the 20-period moving average, and then reversed, and you can see we finished the day in a positive fashion. So we're in a bullish position for the transports, certainly above 91.42. Has to be with a bullish bias. It doesn't mean I'm long the transports. It doesn't mean I want to buy the transports on Monday. It just means the transports are in a bullish position as opposed to the alternative. We're above the moving averages, above an important level. It's in a bullish position, no two ways about it. Now, I just want to show you something interesting, and this is very, very detailed stuff, but this is the way I look at the markets, and we'll see if you think it's useful or not is up to you. But I thought I would make mention of something that I find important. This is things I look for. So now we're on the weekly chart of the transports, and I'm looking at the chart and I'm saying, is this a bullish pattern consolidating up in the upper range, or is it potentially inside of that a shorter bearish pattern that has just made a bearish wedge pattern, potentially setting up for another move lower? So let me give you the different set of information or information that most people wouldn't look at. And this is the way I analyze the markets. And it doesn't matter whether this could be a 10-minute chart or a weekly chart. But here's the weekly chart. And what I'm looking at is the up move. Okay. And now what we had was we had a weekly close below this candle here, the last candle. The low of that candle was 90.4622. Now we closed this week here at 90.4390. Now, most people wouldn't give that a second thought, and what I'm about to tell you doesn't necessarily work out 100% of the time. Nothing does. But what this tells me is that was an initial sign of a bearish tinge that I had in the transports when that occurred. And the reason is because, generally speaking, the market would close the week above that level of the last upward candle. And most people would say, well, what difference does it make? Why is that important? It's in a bullish position any way you look at it, above all the moving averages. It's a weekly chart, and it's just making a consolidation pattern in the upper range, a bullish consolidation pattern like this. There's nothing wrong here, and that may be true. But when I look at numbers like this that are only a couple of points away, and they had an opportunity to close the market that week, on that Friday afternoon, above that important level, which was the low of the week of December 9th. And they didn't do it. That tells me that there was some kind of warning signal or shot across the bow that was sent forward. Now we're trading in a bearish pattern inside of the larger pattern. Okay, so what that tells me is that we are prone to complete this bearish pattern back down to lower levels. Now, whether you're trading the transports or not makes no difference whatsoever, because this applies to any chart. And the point I want to make is we don't necessarily know exactly what's going to happen one way or the other. We all know that. But when we look at things, and I say to my, and I'm going to tell you how I use this information. When I look at information like that, if it was a stock or if it was a market that I was looking to make a trade in because there was a setup and I saw that, I would not make the trade, whether it was long or short, because I'm looking at this and I'm saying there's conflicting data. There's divergences within this chart that I'm not willing to gamble on, because based on how I analyze the markets, the conflicting data that I just explained to you reduces my probabilities of success. And when my probabilities of success are reduced, I don't want the trade. I'll find something else. I know what your next thought is. Doesn't this guy have anything better to do? And the easy answer and simple answer is, I love doing this, and that's why I spend the majority of my waking hours in front of charts. Which is also how I have discovered things over time. I've learned things from other people, but I've also discovered things on my own that most people just have no idea about. So for me, it works and I have fun. So when you have fun, it's really not work. Okay, enough of the soapbox. Back to business, back to the daily chart. And we're going to go over to the gold market and review what's going on there. Now, the gold market was up about $8 or $9 today. It doesn't reflect on the chart. You can see we're at a different price. We're at $12.10 as I make this video. We'll go to the hourly chart and you'll see $12.10. That's where we are in the gold market. And it's interesting because what's happening in the gold market is we're continuing what I suspected was going to happen, and we're going sideways. They make attempts at a rally, and then the rally gets rejected. And we're basically just going back and forth in this range. And as the longer we do this, the more chance we have of higher prices coming, and the 1225 level, maybe 1220, between 1220 and 1225 becomes more and more likely. So nothing's really changed in the gold market since yesterday or the day before that. We're going sideways, but we remain in a very, very bullish position for the gold market. The longer this can, go sideways and consolidate, the higher price can go. But it's gotta find itself maintaining daily closes at minimum of above $1,190.20. Any close below that, or even hourly closes below that, and there's likely something else is going on. But as it stands now, bullish position, looking for higher prices. For those of you still in the GDX trade, which is the gold mining stocks, you can see the same routine here. Going sideways, everything looks fine above the 20 and the 50 period moving average. Once this does break higher, you're going to have a lot of resistance at 25, but if it does break higher, it can get to 25. Let's take a look over at silver. I don't want to skip the silver traders out there. Same routine as gold. We're basically going sideways, no new information. Everything is fine in silver. We're above the $17 level. That's pretty critical. As long as that's the bullish, or the most bullish, I should say, position that silver can be in. Below that level, turns a little bit, but still remains bullish above 16,697. So that's where we are in silver. Same routine, same story as gold. When we look over at crude oil, we saw a big update today in crude oil, up 2%. I'm pretty sure I hinted of higher prices last night in crude oil. And that's what we got. It ran right into the 20-period moving average, backed off. But here's the deal in crude oil. So over the weekend, and I just learned this today, I wasn't even aware of this until this afternoon, you have an OPEC meeting taking place or some kind of OPEC event. And normally I don't really care about those, but this one's interesting because what's happening is the OPEC, I guess, different nations are going to be required to show or prove that they have adhered to the production cuts that they all agreed to. And whether they do or they don't, or they're lying or they're not, or they make up information or they don't, who knows, who cares? The point is this. Based on how that information comes across, the crude oil market is going to react. It's going to either react up or down, obviously. Well, we don't know which way it's going to react off of a news event like that, but what I can tell you is this. When crude oil opens up on Sunday evening at 6 p.m., it's either going to be at $54.50 or $55 in that neighborhood or higher, or it's going to be lower by a substantial amount, or it's going to open lower and continue lower by a substantial amount. So it's not tradable because you can't get in before the gap up or down happens, and today would have been just a guess. So I'm just telling you what's happening, and it'll be interesting to see which way it goes. But I can tell you that if it's going to open higher, we go to a minimum of $54.50 to $55. And if it's going to open lower, it'll open lower and go lower by a substantial amount. And the lower number, we could be all the way down at $50.25. Not necessarily all in one day, not Sunday night alone, but ultimately, if the move is lower, that's most likely where they're going to go, $50.25, $50 in that neighborhood over, a reasonably short period of time. And by the way, and this applies to basically across the markets, Tuesday, the 24th, is a pretty important day as far as I can tell from my cycle work. So we'll see what happens, whether the market moves big on Monday or is quiet on Monday, not really sure. But Tuesday, I think there could be some movement Tuesday in all these markets, one way or the other. Could be Monday and Tuesday. But in my book, Tuesday is an important day, but that certainly could materialize on Monday. Next week's important. We'll leave it at that. All right, we'll take a look at the bond market. The bond market had a little bit of pressure on the downside today, tried to recover, actually closed pretty well. Not 100% sure which direction the bond market's going to go next week. I would think that if the market's selling off, we would see higher bond prices, but all in all, it's tough to say. We're in a precarious position in the bond market. And what I mean by that is, you see this green candle here from the 5th. The low of that candle is 150.14. And you see what's happening here. We closed the day above that level, below the moving averages, tested below that level 2 days in a row. So this is make it or break it for the bond market. Either we're going to rally out of here and it'll be a pretty substantial rally, or we're going to break down. And so we'll let the market dictate what happens, but it's a pretty interesting position the bond market finds itself in. We're teetering on breaking down right now, so we'll see what happens. And last but not least tonight is the dollar. Down day in the dollar, still bearish, nothing's changed. We've just been continuing to have downward pressure in the dollar, and my belief is because the dollar wants to get back to at least par or lower to satisfy that itch, if you will. It's got to scratch that itch, if that makes any sense. Below the moving averages, bearish position, the dollar is going to back down to 100 cents on the dollar, 99.50, in that neighborhood. That's at the point and when we'll be looking for signs of a reversal. And nothing's changed since we've been telling you that for the last couple of weeks. Any rate, everybody, I'm wishing a great weekend. I'm David Frost, My Strategic Forecast. Thanks for tuning in for another episode of Common Sense Market Analysis.